Thank you so much, Team 5, for the amazing presentation. And now we are down to our last team of the day. Let us warmly welcome Tabab Capital to the stage.
Good afternoon, everyone. We're Tewodros Capital, and today we're presenting our pitch on MSA Safety Incorporated. Over the next few minutes, we'll walk you through the business model, growth drivers, and why MSA presents a compelling opportunity. Our recommendation is straightforward. We recommend a buy on MSA with a target price of $207, implying a 30% upside. This recommendation is based on three main pillars: durable, regulation-backed demand, future growth, and strong and stable earnings. So first, Anani will walk you through the company and industry overview.
Okay, I'll now proceed with the business overview of the company. So MSA Safety is a global leader in advanced safety products, which protects customers in hazardous environments. So the company has three core revenue segments with diverse end markets. And the first segment is the detection segment with 38% of revenue, and the fire service segment with 37% revenue, and the industrial PPE is 25% revenue. So as you can see on the top line graph of the company, it has a consistent top line growth, which is supported by the company's business modes, which is intangible assets, high switching costs, and the regulatory barriers. And the company's strengths are the market leadership position, its high return on equity, a strong future cash flow generation, and its no net leverage ratio. And for the weakness, we can mention its geographic concentration of customers, mainly in South and North America. And the company has clear opportunities in connected technology, their margin assertive acquisitions and regulatory tailwinds. But the threats are the cyber state threats and the intense competition that they are facing currently. The company has a strong free cash flow generation and net leverage, which is below the industry target range, which shows the company has a strong financial statement and operational efficiency and the capacity for capital deployment. For the industry overview, it operates in regulated mission critical safety markets, and they have a very sticky customers and high entry barriers. And as you can see, the total addressable market for 2024 was more than $10 billion, and that's expected to be growing to more than $12 billion in 2029. And the fastest growing segment in this industry is the detection industry. Okay, for MSA's competitive advantage, we can mention its pure play specialization, which focuses mainly on safety technology, and this gives the company a superior engineering compared to its peers like 3M, Honeywell, Ansel, and DuPont. And the connected innovation of the company or integration of sensor and software with their hardware equipments drives the company's operating margin to a higher position. And they have strategic M&A, which drives the value of the company. And the premium brand trust gives a loyal customer base. Now, Dagan will proceed with the investment thesis.
So now that we've seen the business and industry overview, I'm sure you're all wondering why we're recommending a buy on MSA. That's what's exactly what we're about to break down. We have three solid investment theses that makes us confident this is a smart move to invest in. Let's dive into the first one. MSA has durable regulation-backed demand. MSA's revenue is anchored in laws and safety standards, not discretionary spending, which makes demand durable and highly resilient across economic cycles. You can see that revenue showed about 18% year-on-year growth from 2022 to 2024 across a period that included macro slowdowns. Underneath that, there is very strong customer loyalty. MSA's century-long brand presence in safety equipment helps it win and retain large, long-duration contracts. Beyond durability, the real upside comes from innovation and ESG that could drive future growth significantly. MSA is significantly moving towards a connected safety platform rather than just a manufacturer. The MSA Plus connected safety platform integrates hardware, software, and services with subscription pricing, making revenue more recurring. This ties directly into ESG. MSA's connected safety and leak monitoring solutions help customers hit measurable safety and environmental KPIs, making them fewer emissions, and lower incidence. Those budgets tend to be harder to cut and they support premium pricing. So innovation in ESG connected platforms makes accelerates future growth with higher margins and recurring revenue. Finally, MSA has stable earnings combined with long history of dividend growth, making it a low risk, high quality growth investment. If you look at the returns over the past decade, MSA delivered about 268% total shareholder returns, clearly outperforming the S&P 500 and the S&P Mid-Cap Index. And then there is a long history of dividend growth. MSA has delivered 55 consecutive years of dividend payment with regular increases, reflecting its commitment for shareholders' returns. Taken together, we believe that MSA is a high-quality compounding investment with strong track record and substantial potential for future growth. With that, I'll hand it over to Jordanos, who will walk you through the key catalysts and risks for MSA.
Now we have encountered the thesis. I will go through the key catalysts that support MSA's growth as well as important risks we accounted in our investment view. At first, we can see the NFP 1917 self-contained breathing apparatus upgrade. So MSA is one of the two companies that is already certified for the updated 2025 standard. So this enables MSA to capture a high margin orders. At second, we can see the MSA's as it's connected to solutions with Altar AO4 solutions. So this creates recurring revenue because of the high switching costs. Finally, we can see the margin expansion in the capital deployment, operating margins over the years. So MSA has expanding its investment in the acquisitions. When we come to the risks, we can see, although the NFP 1917 transition is a catalyst, the transition period may create a short-term volatility. However, MSA's decades of experience may reduce this execution risk. Secondly, as MSA expands into connected risks, it can be to potential data breaches. So MSA will maintain this with strong security control. Now Mehretab will proceed with the valuation.
Now that we have established the proposition, risks, and catalysts, we now move on to the valuation. Now for the valuation, we just took a simple bottom-down approach from market size to market share. Now, taking into account from management's expectation based on their outlook, there will be a market expansion for both segments. Now, we did the COGS, OPEX, and the DNA, a simple percentage of revenues. And the company has a net debt of $343 million. And for the working terminal growth rate, we took a 7.9 and 3% growth rate. Now, to triangulate this value, we took an exit multiple of 12.3 multiples, X multiples. We just took a conservative assumption of below the market average. Now, for the perpetuity, the DCF valuation indicates a 30% upside potential versus its current share price, standing at $207 versus its current share price of $159 of 30%. And also, again, looking at the exit multiple for triangulation, it yields about the same result at $209, which is a 32% upside. You can look at the sensitivity analysis here. Now, for the comparables, there's an average of EV to EBITDA multiple of 13.4x for the industry average, and this gives us an implied price of $186 for MSA. Now, looking at the full board field chart, the average valuation of $215 million concludes our valuation. So in conclusion, regulation-backed demands, ESG and innovation, and high regulatory barriers with quite strategic risk mitigation methods gives us a compelling argument that MSA is a good company to buy. And and also another note, the company's colors matches with the ECMS team, so we recommend a buy.
So for this company, growth is obviously dependent on acquisitions. How is M&A factored? How are mergers and acquisitions factored into your projection model?
Yeah, so the company, we can see the revenue growth rate, but the organic growth rate is 3 to 5%, and currently it's at 1%. but the company is very aggressive on acquisitions. So you can see the revenue growth mainly depends on acquisitions because the organic growths are weak. So we can say acquisition is a good part of the revenue growth lines. And also, moving on to the MSA Plus integrated systems, the company has dramatically reduced its operational margins from 90% to 20% to 23%. Now they also forecast that based on the management's outlook, it's estimated to be at 25% operational margin. So the culmination of these factors adds into the revenues, top line steady growth.
Okay, so in your model, this is a really good company, by the way, and you guys have done a ton of research, so I'm gonna ask some more advanced questions on the model.
Thank you.
In the beginning of your model, there's total debt of 508. I think is that million or is that thousand? There's anyway, it's 508,000. I don't know what the metric is, and on exit it's 343. So if there are a lot of acquisitions, how do you expect net debt or debt to be lower on exit?
Oh yeah. So mainly the company does not acquire with leverage. So the company has strong free cash flow. So we just saw on Q3 of 2025, the company spent $50 million on share repurchases and other capital deployments. So we can see, and the company just got rid of its product liability expenses worth about $500 million. So it's safe to say the company has good cash and there's no reason for it to get more debt. And you can also see for the net leverage, it's been on the decline for the past multiple years. So the net leverage is well below the industry range. So we believe there's room for debt, more room for debt, means more room for acquisitions. But currently, based on the company's free cash flow, we don't see a good enough reason for the company to take on more debt to acquire companies.
So thanks. Very nice model build, by the way. That's really nicely done. Two things I see for this company is you mentioned there is significant geographic and customer concentration, and there is also intense competition on the company. Has that been factored into the scenario when you do the model? Because this is very critical, right? If a company is very much concentrated in a specific number of companies, and there is intense competition, that means they could actually lose some of the customers.
So, great question. So, for the geographical concentration, the company is more concentrated on the US and Southern America. But let's not forget the company also has great presence in Europe. The company also mentioned it's expanding into the Asian market aggressively, coming into the next years. So, to answer your first question, that's it. And the second question, when it comes to competition, is we didn't really focus on the comparables because the company is really difficult to fit it into the competitives because the competitors are Honeywell and 3M. Now Honeywell, as we all know, manufactures between, fight jets into ACs and jars, water jars. So the company is not really superior in engineering. The competitors are not really superior in engineering terms. Now, but looking at the MSA's company, it's been around the block for 100 years. More than 100 years, I believe. And they have superior technological advantage. And because of their linear build, they have more focus on innovations. We can look at the case studies on the appendix. Yeah, so if you look at all these case studies, they are innovations because they pay close attention to their customers because they're not that big companies like Honeywell and 3M. So these companies have a long-term relationship with their clients and they listen to their clients, which gives them much more attention to the market. And these are just the innovations they came up with because the market needed one. And to come up with a fast innovation like this needs to have a company that pays attention to its customers. So that's where the company really gets the edge on its competitors.
In terms of the geographic opportunity, I'm interested in what are the types of customers outside of the US, so particularly in Asia? Are they government type contracts or is it more of a manufacturing activity? And sort of related, you sort of mentioned this was becoming less of a manufacturing company and more of a sort of control solutions company. And to what extent is it a consultancy, and to what extent will it become a consultancy in the future?
If I may just add a couple of questions related to that. First of all, since they're going into more of a technology-based, service-based, do they have any patents for all the stuff that they're working on? And if what percentage of their production actually comes in from China? Because it does impact tariffs and all that stuff.
For the first question, most of MSA's revenue comes from the government contracts. For example, we can take the LA's, the contract that the company has with LA Fire Service segment. They had a long-lasting contract with the company, and that's mainly where the revenue comes from. But if you have anything to add.
Is that the same in Asia?
It's not the same in Asia. The contracts are more concentrated in the US.
So the NFPA 1970 regulation upgrade cycle, you can see it's a legal compliance for companies to upgrade their safety cycle on the 2025 latest model. So one of only 2 companies are certificated to provide those products, and the other company is based in Germany and has virtually no presence in the States. So you can say amongst the many patents, G1XR is left for MSA only to operate in the United States, so that gives it a first mover advantage. And on the Chinese production side, MSA does not produce its goods in China, it produces it in US. Now, we can look at it as a risk because there will be a price premium just for producing in the US. But again, the tariffs are virtually very minimal in terms of threatening the company's revenues. My partner Dagum will add some.
In terms of maybe moving into a tech-based company, they have recently acquired MSC Tech Group in 2025 for around $200 million, and this is projected to make an increase of 500 million in total addressable market. So that's one point that we can see that it's moving towards more tech-based company.
As you rightly said, most of the revenue of the company is legally mandated, not discretionary actually. So this is a big opportunity, but don't you see a risk here? Because in case there is some relax from government side for the major markets, will there be not just a decline or demise of the company, days of the company?
So in here we can risk. So the transition period, the adaptability may create a short-term volatility, but MSC's decades of experience and a strong engagement with early adopters help to reduce this risk.
Thank you so much, Team 6. That was our last team presentation for today. And for our judges, thank you so much for your invaluable insights. Let us warmly send them back to their seats. Thank you so much.